Good evening to everyone present here today. We have our product manager Jason D'Souza who will reveal the keys to determining a stock's true value amidst recent market fluctuations. Towards the end, we would also be having a Q&A session. Over to you, Jason.
A very warm welcome to each and everyone present here today and welcome to today's event. Over the past few months, Nifty has seen some 9 to 10% correction from its all-time high. And along with Nifty falling, a lot of stocks have also corrected and they've kind of become undervalued today. So in today's event, we'll try to find out what or which are these undervalued stocks. When I say undervalued, what exactly do I mean by value or the true value of a stock? I'll be showing you all 4 different strategies you all can use in the current market to find these stocks. And as I've promised, I'll also be revealing 3 undervalued Mojo stocks in today's event. So let's start off this disclaimer. Investment in securities subject to market risk. Past performance should not be construed as a guarantee for future returns. Now, before we jump straight into undervalued stocks, let's take this particular term called intrinsic value. Since many of the webinars I've been doing, I get a lot of these questions. What exactly is the intrinsic value of a stock? Or let's say the true value of a stock. And I'm going to show you all a particular equation over here. Let's take the intrinsic value to be the market value of the stock plus or minus some investment opportunity, some gain or some loss from the current price of the market. Many of these analysts try to find out what's this intrinsic value. So let's assume for a stock, the intrinsic value is 300 and we have a market value, that means the current price of that stock, which is 250, plus the investment opportunity. Over here, if you just finish off this calculation, there's a 50 rupees upside potential in this stock. Okay. Now, analysts aim to find out what's this intrinsic value. Whenever someone gives you a buy or a sell call, they have this intrinsic value pictured in their head. Okay, let's say I am going to invest in ITC today, and I believe the intrinsic value, the true value of the stock is at 500. Okay, so I expect that stock to move upwards. That's where I'm trying to grab this investment opportunity. But the funniest thing is whenever you go to the stock market and you buy a share, there's always a seller. So someone thinks the price can go down as well. How can we find out the true value of a stock? Let's move on. There are different methods to do this. And some of the most used methods today, there is the discounting the cash flows, the future cash flows of a stock. Okay, there are financial metrics used. Whenever you Google about, let's say, intrinsic value, you will find these different ratios, P ratio, PEG, EV to EBITDA, so on and so forth. And lastly, there are asset-based valuations to find out the intrinsic value of a stock. Now let's look at each of these small methods and let's try to find out how we can find out the intrinsic value today. Let's find out which ones can actually be accurate. So as I said, discounted cash flow, nothing but discounting the future cash flow of the company. We use a rate over here, a discount rate. Okay, for equities, it would be higher. I'll not jump much into this. We also have financial metrics like the PE ratio. We analyze a lot of ratios to find out the true value of a stock. And lastly, as I said, the asset-based valuations, where we try to find out a difference between the asset liabilities and reach to the value or the intrinsic value of a stock. But if you look at these different methods, there are some benefits and there are some disadvantages when you use them. Okay, for example, when we say discounted cash flow, we're looking at future cash flows. And in the current dynamic world, when COVID or like a worldwide pandemic can hit you, when the interest rates are being increased for the, let's say, one entire yearly period, nothing can be certain. So when you look at discounting future cash flows, you have to be Nostradamus to predict it. Okay, I'm not trying to be funny. You have to actually look at a company and assume what its future cash flows are going to be, where you can really go wrong. The intrinsic value you calculate here might really go wrong. You can also look at PE ratios, but that PE ratio something is not useful when you only look for one company. If you just calculate the ratio of a company, it doesn't make much sense. And lastly, when you talk about asset-based valuations, we are talking about the asset or liabilities at one point in time. Okay, so we disregard the prospects and the past what has happened. But if you look at it, some methods have some benefits and some of them have their own disadvantage. What we are trying to do here when we find out the intrinsic value, we are trying to eliminate all the drawbacks and use the benefits to determine the true valuation via the valuation dot. Okay, this is nothing but one of the dots used to calculate the score of a stock. We calculate valuation in quite a different way. Okay, we use some of the Second one, which is we look at some of the financial metrics over here. We look at some of the asset-based valuations. We eliminate this because, as I said, you have to be really you'll have to be really a good astrologer to actually predict the future values. So we ignore this method, but we look at all the benefits we can get out of these methods, all the advantages, and eliminate the drawbacks to reach to this valuation. Now you will have to understand this dot a bit. You will have to understand how we look at the valuation of a company, because today if you're going to try and find out which are the undervalued stocks in the market, you have to understand why we said it's very attractive. Let's move forward. Now, I've been trying to make you understand what's the value of a stock. When you look at the true valuation at MarketsMojo, let me take you to the site over here and let me search a particular stock. Okay, I'm looking at TCS for now. Okay, and I'm going to the valuation of TCS. Now currently it says TCS is an expensive valuation of a stock. Now when we calculate the valuation, let's say for example of TCS, we look at its past and we look at across its relative multiples. So we're looking at Infosys, we're looking at all the other companies in the IT sector along TCS. Okay, that's how we're trying to find out the valuation of a stock. It's not looking at one particular stock and saying its price is high, so it's an expensive stock. No. Okay, it's a dynamic non-linear regression model and it tries to consider the ideal price based on the fundamentals, okay, which sector the stock is in, and we look at the debt as well. And finally, the valuation dot at MarketsMojo is updated daily. So the one benefit here is that if any particular advisory says this stock is undervalued, the problem is that after 1 month, you don't know if the stock has now become expensive. That particular research house has to again publish a report. But on MarketsMojo, the benefit over here is if you come on the site, that valuation is updated daily. Okay, so there's no, if there's a particular stock where we say it's expensive, the next day it can become fair, and then, after let's say a month, it can become attractive also. So it's updated daily on the website, and that's how we print this particular chart for you. I'll be using this chart to get a slight example of the different range of stocks when they are expensive, when they are attractive going forward. Okay, now let's review the valuation of a stock before we go forward. Let's look at what we calculate when it comes to valuation. Now I've done a lot of different events like decrypting the CFT score, decrypting the quality of a dot. I was planning to do a decrypting the valuation, but this webinar, this first half will actually explain to you what exactly is the valuation, how we calculate it. For example, this is for TCS over here. You can see the first card over here is the scorecard. This is the verdict for valuation of that stock. TCS is expensive. Here we've calculated some of our key factors we use to calculate the valuation. Now, the benefit here is that you're not looking at one ratio. We're looking at 2, 3, many of the ratios. Okay, so there are price multiples. Okay, we're looking at the earnings value of the company. We're also looking at the growth, the dividend yield, which is important, and also the return on capital employed, return on equity. So we're looking at a lot of ratios, and it's not just 1 or 2, and you're getting an entire, you're getting an entire understanding of the entire company's fundamentals at one screen. The third one is something which is important because this is a snapshot. So if I tell you, what I feel TCS is expensive at this range, I know when it's going to become very expensive at 3683. Okay, I'll know when it's at the fair range over here at 2716 to 3059. And lastly, you can compare it with its peers, which is very important when it comes to valuation. Which is why I tell investors, when you look at the value of a stock, when you say it's expensive, you're also looking at its peers at the same time. Okay, if I click on this full details, just to give you a small example, TCS is expensive, the PE ratio is over here, the EV to EBITDA, so on and so forth. Infosys is fair. If you see the PE ratio is slightly lower. Okay, even this is slightly lower over here, which is a good thing. Okay, so here you can see even the PEG ratio is lower. So that's why Infosys has actually, we look at all the indicators over here, all the ratios, but there are 3 over here for you to get some idea. Okay, and that's how we are comparing with its peers. So 191 in the IT software industry. Okay, so you can see Oracle Financial Services for all the stocks. You can also do a sort in an advantage or ascending or descending order. Now coming back, after we do these 4 different things, we reach to the intrinsic value or the true value for stock. It's not just one calculation or one method. Now that we got some understanding कि ठीक है ये valuation क्या होता है, we'll now slowly move towards strategies. But before I move to strategies directly, let me give you some practical experience or what I've actually seen in the market. This is one of the theory I've actually explained to you. But what exactly is happening in the market is much more important to understand. In one of the recent events, our Chief Investment Officer, Mr. Sunil Damania, he had actually looked at the latest letter of Warren Buffett. Okay, and in that particular letter, there was a statement. And that statement was that, I'll just quote unquote, it's crucial to understand that stocks often trade at truly foolish prices, both high and low. Okay, efficient markets only exist in textbooks. In truth, the marketable value of stocks are baffling and their behavior is only understandable in retrospective. Let me break down these 2 points he's clearly examined. No, the 2 points I want to actually break down today. The first one is efficient markets exist only in textbooks. What I mean by this is all these different ratios I showed you right now, they're good, but they are mostly theory in nature. Okay, they exist. If you're actually solving a sum on trying to find out the intrinsic value, it works over there. But in the actual market, it's quite different. What I mean by this is that a lot of times we come on the website and we see the valuation of a stock. Many of the investors ask me, Jason, the valuation of the stock is very attractive, but it's not moving upwards today. Okay, so why is that a very expensive stock, for example, is not moving downwards? You know, in the market, something completely opposite is happening because these calculations mostly exist in the textbook. What happens in the real world depends a lot on the market expectations. Some of the strategies I take you across later, you will get a slight understanding of this. And the other one is, it's understandable only in retrospect. Okay, so in hindsight, if you see a stock today and you see it's gone up by 80% in 1 year, and you say, you know what, it's gone up by 80%, I don't think I should enter it here. You know, let's forget this stock. मैं कुछ दूसरा stock देखता हूँ. And after 1 or 2 years down the line, you realize that that stock has gone up by 200-300%. You missed that stock when it was at 80% because you thought, you know, if it's increased by 80%, now it's expensive. So that after 3 years, when you see the stock, you're like, okay, it's gone up by 300%, I missed the train. That's what happens. When we look at the valuation of a stock, we said, yaar, yahan pe entry lena chahiye tha, yahan pe entry lena chahiye tha, yahan pe lena chahiye tha. But on that day, you're not able to understand because it's actually come up or it's actually moving downwards. This point was required. And I added this slide because I don't want to just explain to you valuation and show you some 4 strategies. I had to add this slide. The reason for adding this slide is you can't actually base all your decisions on the valuation of a stock. It's really an eye-opener. I've called you for a webinar on valuation, but I'm actually telling you, don't base all your decisions on the current valuation of a stock. It's quite difficult to say that a stock is expensive and it won't go upwards. Instead, you should also look at the Mojo score before going with your final decision. Because the Mojo score looks at 3 other things along with valuation. It looks at this current market expectations. Remember, I showed you that first particular formula, the intrinsic value, okay, where I added the market expectation. The score looks at technicals. It understands the price movement, the demand of the stock in the market. Fundamental strength by CFT and also the quality of the stock. Okay, what I mean by that is when you reach, now let's say for example, I've reached to TCS and I said, okay, you know what, the valuation is expensive. That's a really, it's a really big problem for me. I'm at an expensive range. I'm holding this stock right now. I think I should exit it. But that's not the thing you should do. You should always finally go to the final Mojo score of the stock. Now this stock is somewhere near hold. So even if you want to exit, you can wait for a while because it's somewhere near hold. These 4 dots you see over here, from that only 1 dot is valuation. You can't simply, stick with this dot with any of the strategies and say, if this dot is green, I'm going to actually go and buy the stock. This 1 dot. Look at all 4 of them and then base your final decision. Okay, because the valuation is expensive, so you might think the price won't go up. Okay, and you're actually thinking it's in an expensive range, but the returns might actually go up for the stock. This is just an example for TCS. But in the real world, you can't stick to valuation. Don't base all your decisions solely on valuation. Okay, this particular thing over. I think now we are clear out a bit. We kind of understand what is the valuation I'm talking about today. What are the different methods we're looking at? And it can't be your final gun. You can't say, this is the valuation, it's attractive, I'm entering the stock. So these 2 things are cleared out. I think now we are much well equipped into going into strategies and understanding what are the different strategies we can look at. Let's review these strategies, 4 different strategies. But one important thing is that these are not direct recommendations, okay? So if I show you a particular screener and I show you the different filters I've used to calculate them, don't simply pick that stock, add it to your portfolio and go and buy it tomorrow. Please look at your overall portfolio today, understand your risk appetite, Are you investing in a very small stock? And then go ahead into, investing in these stocks. The one important thing before I move on is that price is just a number here at MarketsMojo. I've explained to this a lot to investors before. It does not solely define the value of a stock. What I mean by this is, look at Yes Bank today. When we talk about Yes Bank and we say the current price is 15, and people come to MarketsMojo website and say, you know what? Yeah, this is actually expensive. It's actually attractive. It's 15 rupees only. But why have you marked it expensive for Yes Bank on the website? Because the low price stock can be expensive if the fundamentals are not supporting it. We all understand about the fundamentals of Yes Bank, okay? If it's not supporting it, even at a small price, it can be expensive. Or on the other way, there's a stock called WPIL, where the price is currently at 2000, but it's still attractive because the fundamentals are supporting it. Don't look at price, the stock price, and say, this is the price, it's about 1000 rupees, so it's expensive, below 200 is attractive. That's not how we look at stock prices. Price is just a number. We have to look at the underlying earnings of the company before we reach to valuation. The first screener, the first strategy I want to show you all today. So we'll talk about these strategies, then we'll move to the Mojo stocks. But the first screener I want to show you today is if you want to find out the most attractive stock in a particular industry. How do we reach to that? Okay, if you're looking to identify a particular attractive stock within a particular industry, the reason I'm saying within an industry is we cannot go all across the market. If you want to pick up a good automobile stock, you will put a filter of automobile. Okay, now this analysis gets more accurate if you look at a particular industry, let's say auto sector, and within a market cap. So auto sector large cap. Okay, you can't compare auto sector large cap with some auto sector micro cap stock. Okay, you have to mostly look at the similar market cap range. Let me take you to the screener first. I'll just go to screener. The way you can go to screeners and find out your strategy is go to professional and go to make your own screener, which is this fourth option over here. Now what I've done is, since I'm doing 4 different strategies, I've also saved the different options over here so that we don't have to actually, go and create each strategy again. But I'll show you the first one. I'll clear all filters. Attractive in a particular industry. First we said attractive. So let's select valuation and only pick up the attractive and very attractive stocks. So you can see 4118 stocks currently in the system. And if you look at attractive and very attractive, the number is 659. Okay, so with the market being falling, you can look at Sensex has been falling since some good time. Nifty has been falling. Many of the stocks might have not been attractive, but now they've entered this range. Since the price has gone down, the fundamental story is still intact. Okay. The next one is select an industry. I'll select paper for now so that you get some idea. So I'm going to select paper and paper products. And some additional filters for reviewing. The reason I'm using these filters is that within valuation, we can also see what are the attractive ones using these 2 different ratios, I'd call them. So I'll go to valuation factors, and within valuation, you can use any of them, but I'm just using 2 of them. So I'm using price to book and EV to EBITDA. Okay, and if you want to find out which one is more attractive in these particular ratios, the lower the better. So we'll run the analysis over here. Okay, so right now within the paper industry, let me just sort out on very attractive stocks. Okay, so within the paper industry, if I want to find out which stocks are very attractive and attractive, these are the names. So we have West Coast Paper, Satya Industries. Okay, I can also use these ratios and sort them in the ascending order. So you can see Star Paper Mills is a microcap stock and it looks very attractive. The ratios are lower as well. Okay, so it's a positive plus point. Can be the lowest, but it looks like the most attractive in the microcap paper segment. Okay, so any of these stocks you can see, but remember this is a microcap, so it's quite small. Okay, and if you want to remove these small companies, you can simply go and add a filter. Okay, I want to actually exclude very small microcap companies. So I'll go to market cap, which is the size, and I'll exclude them. Okay, so I can see only 5 stocks now in this particular list. Andhra Paper, West Coast, Satya Industries, JK and Quantum Papers. Okay, I can see these are very attractive and these ones are attractive. And now they're in the small cap and mid cap range. So you can compare them together. My point is that I'm not looking at one very small and one very large cap company. So you can compare these together and understand within an industry. Now I can just simply change the industry filter if I want to and dive into a different industry. What I mean by that, I'll go to industry and instead of paper, let me go to, let's say, FMCG. Okay, and just tick mark. You can see 7 stocks now. We had 5 in paper, 7 in FMCG. So these are the attractive and very attractive stocks in the FMCG sector. Okay, I can click on any of them and further go and understand them. Okay, let's look at the stock. It's currently a sell, so even though it's attractive, it's not worth looking at. You can look at other stocks. Let's look at okay, this is very close to hold, so it's currently not a buy, so you cannot go, but it's up by 6% in the last trading session. Okay, and if you look at the valuation of the stock, it's currently at a very attractive range, till 3083. So it's currently very, very attractive. It's at 2233 and still 3083. Only when the stock reaches 8489, we believe it's expensive. So this snapshot can give you some idea before you enter. Don't enter somewhere, if you think it's just at the border. Let's look at the financial trend. So see the recent performance. Okay, the recent performance has also been good for this company, but you can see it's corrected in the recent period. From February, it's actually gone down. Otherwise, it was on an uptrend. So this is the first strategy if you want to find out the most attractive stock in one particular industry. This is quite simple. Let's dive and go a bit more deeper. So which companies are attractively valued, have performed well recently, but the market has not rewarded them? Okay, again, I'm going back to that particular formula which I explained on the first slide. We look at the intrinsic value, we're looking at the market value. That market value is not, it's in a lower range today. The market has not rewarded them. These companies are good, but the market has not yet rewarded them. Okay, so despite positive financial trend in the latest quarter, okay, in the December quarter, these stocks have not been rewarded in this year. Since January, they've not been moving up. But this one thing I wanted to focus on, why I've added this particular thing. Okay, so positive financial trend, but they are not moving up, but the technicals are bullish. So we can catch these stocks which are actually going in the uptrend. They've been corrected, but they can go in the uptrend. So let me show you what's this filter. I'm looking at the valuation where I add attractive and very attractive. I'm looking at the latest CFT score. So the latest quarter is positive. So I'm looking at the latest CFT score. Okay. The year-to-date return, that means the January return from since January 1st to date is less than 5 because the market has not rewarded these stocks. Okay, I'm just trying to explain to you how I've selected this filter. And the technical grades are bullish, so these stocks are now on the up move. They've not moved up much this year, but now they are on the up move. Let's go to the site and look at the screen now. So I can go on these 3 dots and I can just actually select them from here. Okay, attractive companies, the market has not yet rewarded. And you can see I've reached to 43 stocks over here. Okay, these are the different stocks. And now if you want to actually, before going and buying any of these stocks, okay, this is the list. Before you go and buy, look at these returns year to date. So this year itself, these stocks have fallen by 30%. But the technicals are mildly bullish, so they have some chance of moving upwards. Okay, so look at this particular stocks over here. Okay, we have, for example, we look at eClerx services. Okay, let's look at Bharat Bijli. I've not heard of Bharat Bijli, but let's look at these stocks now. Okay, if you see what I've said, attractively valued. So let's look at the valuation. It's currently attractive. Okay, and now the positive financial trend. So the latest quarter was positive. Okay, you can see it's positive over here at 14 and technically bullish or mildly bullish. So it's on the move. If you see the technicals, it has turned mildly bullish from bullish on 27th Feb, which is 1 month ago. Okay, over here it has turned 27th Feb. It has actually turned mildly bullish from bullish. Okay, so it is on a downward trend because it was bullish before, but it's slightly moving downwards. So you can skip this particular stock. You can look at the other one. Let's look at Bharat Bijli's technicals. Okay, when this has turned mildly bullish from bullish. The reason I'm trying to find out is one stock which has actually turned bullish or moved upward. Look at Star Cement, for example. Okay, it says positive near-term drivers. And now let's look at the technicals. Great. This stock has turned bullish 2 days ago. We are on 25th March today. It's turned bullish 2 days ago from mildly bullish. Okay, so this is just about to break out, or let's say it's showing some bullish movement. So it's, currently showing an up move in the market. Okay, the reason I went and actually checked each individual stock, because if it's mildly bullish but it has turned from bullish to mildly bullish, it does not make sense. Okay, but still moving to an up move. So here we can find out they're attractively valued, performed well, but market has not yet rewarded them. So you can see there's a upside potential. Okay. you can see this market value which I was talking about, okay, the intrinsic value. There is a chance that the investment opportunity is present in this stock. Okay, so the market value over here, since the technicals are bullish, it can reach its true intrinsic value and finally form, a point where it's reached the intrinsic value. So the market price is down over here, but it's moving upwards. Okay, this is how I'm trying to fit it in this particular equation so you get a better understanding. But let's move to the next one. Let's look at now turnaround companies. This is one of my favorite, and the reason I say it's a favorite, I'm a bit aggressive in nature when I pick stocks. And companies that are turning around their performance is something I like looking into. The plus point over here, they are turning around their performance, but they are also attractively valued. Okay, so potential turnarounds can make substantial returns if the company does well. Okay, so they are about to turn around. Since they are attractively valued, okay, the bounce back can be substantial. What I mean by this is, let's look at one particular stock which has not done well last year, and it has suddenly started doing well this year. Okay, and it is attractively valued. So that bounce back which will come is much more substantial for these stocks. We look at the current financial trend, which is positive. The previous financial trend is negative. This is the turning around of the company. Okay, so the year the company is turning around. Last quarter, let's say in September, it was flat, very negative. It was not doing well, but now it has started doing well. So there's some turnaround which has happened. Valuation, as I said, very attractive and attractive. And let's avoid these very, very small companies. So let's go straight to our screener, the third strategy. Once again, I'll just select them from here. Okay, turning around their performance. 22 stocks. Okay, let's look at some of these stocks. Look at this small cap auto ancillary stock. I've not heard of them. Okay. Now, attractively valued, which is very straightforward. The valuation over is attractive. Okay, and turn around their performance. What I mean by that, the financials, the quarterly financials which are released, is actually turning around. So you can see over here, it has been -5, -2, -1, but December quarter it has turned around and gone to 17. Okay, so it is moved up, but it is still attractive. Okay, the current score of this particular company is buy. Okay, so apart from the valuation, you should always look at the score of the company. Just remember that the quality is average. So it's for a higher risk investor, and it's also a small cap company. So there is a high amount of risk involved in this stock. Okay, just for the safe side, if you look at the technicals, it has turned bullish from mildly bullish on 9th Feb. So around 45 to 50 days ago, it actually turned bullish. Okay, moving on, let's look at this particular screener over here. High dividend yield, low premium cost. Why have I actually selected high dividend today? The reason for that is when you look at the current volatile market, the price appreciation is quite uncertain. Let me break it down in similar terms. When the entire market is slightly in a bearish mood, or let's say the Nifty is actually going down, expecting that particular stock's price to move up can be very uncertain. But dividend is something which is certain in nature. Okay, a company might, announce a yearly dividend, a quarterly dividend. So some money you're actually getting in your pocket which is certain, which reduces the uncertainty in such times. Okay, so in the current volatile environment, any cash flow can be a benefit. Okay, remember we looked at the DCF method, discounted cash flow method in the start. If you're receiving your cash flow, currently the intrinsic value is higher. Okay, these high dividend yield companies provide some kind of assured returns. Okay, it's not 100% assured, but since a company which declares dividend has a good practice of declaring dividends, you're getting some returns in the form of cash and minimum downside. Okay, minimum downside because they are attractive in nature. Attractive company might not fall even more, but an expensive can come down. So you're getting some assured returns, and also the capital which can drop because of the price movement is also protected. So these are much safe companies in today's market. Okay, let me go to the screener and actually show you how you can reach this particular thing. Okay, I'll click on these three dots over here. High dividend yield, low premium cost. Now let's look at these companies over here. Tech Mahindra, HCL Tech, Reddington, GE Shipping. Okay, Quest Corp. It's a mid-cap company. Good quality, attractive valuation, dividend yield 3 points. This dividend yield, this percent you can see over here is something which comes from the company as an assured return. Okay, it cannot be 100% assured, but if you're getting dividend, many people actually consider, like dividend yield companies, especially in times of when the market is heading towards a recession. Okay, I'm not saying there's a recession in the market, But during these uncertain times when people normally rush to buy dividend yield companies, okay, because there is some assured profit from the company which will come to you later. Okay, so this is quality excellent, good, financial trend positive. Okay, you can always save this list what I'm doing over here. This video will also be available later, so you can go back and search these companies. Okay, now I spoke about 4 different strategies, but there's this 5th one which I just added while I was on the way to the office today actually. I wanted to add this one because it's very practical in today's market. And this is why we are here for in the webinar today. Let me just read it out for you. Which companies are fundamentally strong, attractively valued, but let's say unfortunately have corrected in the recent fall? Okay, they are really strong fundamental companies, attractively valued. But as I said in the intro of the webinar, Nifty has fallen down by around 9 to 10%. Many companies have also fallen down. How can we pick these stocks? Okay, this filter is very similar to one of the ones we've used before. I'll just go on the site and activate it for you. Okay, have corrected in the recent fall. Okay, what have I done is I've looked at attractive valuations, good positive financial trend, and I've looked at quality, which is extra over here. Excellent and good quality companies have shown strong fundamental performance over the recent, let's say over the longer period. Okay, so they are not some, companies which have just become good. They have been good in the industry. But unfortunately, the return is actually being corrected, okay? The market has fallen in the market. Okay, and technical grades bullish and mildly bullish, so they are on the up move. Now going to these stocks, what I'm trying to make you, what I'm trying to explain to you over here. Let's look at MAN Aluminium, for example. Okay, it's good quality, valuation attractive. Okay, the return year to date is positive. But if you want to look at some of the ones which have corrected, look at these stocks. Let's say Cupid, for example. Let's open Cupid. Let's open Honda India. Okay, I'm looking at Cupid right now. It's fallen by around 30% fall from high. Okay, it's into rubber products. I think long ago it was a Mojo stock. Let me just check it. Because I think long ago it would have been a Mojo stock. Let me just have a look. Okay, the way I can actually find, I can just go to the full list. Everything is here in a transparent manner. But I can also search. So, okay, yeah, Cupid was part of the list. Okay, yeah, it was part of the list in 2020. You can see a microcap stock and it gave some 23% returns. It was in the list for 2 months and 26 days. Okay. Okay, now this stock is 77 currently. It is a buy. Okay, it's not a Mojo stock, but it's still a buy. If you look at the financial trend of the stock, the financial trend is positive in the last 2 quarters. The last 6 months period has done well. Let's look at the quality. It might be good. Okay, so the quality is also good. It's an attractive value, but unfortunately it has corrected well in the recent fall. Okay, so let's look at the price movement actually. Okay, let's look at the 3-year chart. So you can look at Cupid over here. It has gone up, it has been going up, but you can see it is actually corrected over the last 2-3 months. Okay, nothing wrong in the fundamental story, but unfortunately in the recent market it has corrected. Many other stocks over here, let me just take it. So there is Sundaram Clayton, for example. It's fallen by 23%. Okay, so 33% fall from high. It's 81 at strong buy. Okay, that's why Warren Buffett's statement makes a lot of sense, because you can look, all the dots are 4 and green, but unfortunately there's some market movement. So this stock has fallen by 20% in the last traded session. So it's very high risk. I think we should kind of avoid it. The market might actually be knowing something. So let's just avoid the stock for now. Okay, you can see the other ones are here as well. They've corrected in the recent market fall, but the fundamentals are good, valuation attractive. So this filter I personally thought, or this strategy which I've added just before the event, I thought is much more practical if you all want to find out when the market has fallen, which are the attractive stocks now. Again, technicals are bullish, signifying an uptrend. That market value might actually move upwards. Okay, but this ratio is one thing which we can, look at. We believe the intrinsic value is good, so we've given a very good buy for the stock. Okay, but in the real world, the market value can be different. Okay, the market might be discounting it for some other reason. Okay. Now, coming back to the thing I've promised, which is 3 attractively valued Mojo stocks. Okay, one is that they've been looked by the team and stuff, and these stocks are attractively valued and they are recommended by us as well. Okay, I'm looking at these 3 attractively valued stocks across different market caps. Within large cap, we have Tech Mahindra. It's recently entered the list in the past, only since 10 days. It's a large cap IT software stock. In mid cap, we have Godfrey Phillips. And again, I don't want to actually say it's a recession or something, but during periods when the market is really volatile, people normally move to this particular sector. Okay, people actually move to a sector which, let's say for example, cigarettes and tobacco is consumed all throughout the year. It's a very defensive sector in nature. So there is some protection for your, for your price. There's some protection because this stock is within a defensive sector. And lastly, in small cap, we have Andhra Paper. When we reviewed the entire list of paper stocks in the beginning of this event, okay, remember I had showed you how Andhra Paper was actually the most attractively valued within all its peers in the paper industry. Okay, one large cap, one mid cap, and one small cap stock. Now you have to understand that this can be slightly risky. The reason I'm saying is you should not actually add all your money in one particular stock. If you want to pick up mid cap stock in your portfolio, then you should look at your current portfolio construct and add an equal amount into this Godrej Phillips. Don't just simply buy these three stocks. That's a very poor strategy to play. It's possible that some of them might not work. So you have to add these stocks along with other stocks in your portfolio and complement them. Okay. Let's say in case you don't want to do this picking up, there is a particular theme in mutual funds which is called the value-based theme. What do you mean by value-based theme is that even mutual fund managers actually try to find out which are these attractively valued stocks. Which are these value stocks? I had done a webinar on value versus growth. So mutual fund managers also spend time in trying to find out which are the attractively valued stocks. Here we've identified top 3 value funds. So let's say if you don't want to pick up a stock, you're worried of tracking it. Here you can actually look at a mutual fund in this case because you can add some portion and that mutual fund is well diversified. There's ICICI Prudential Value Discovery Fund. I think it's the number 1 rated value fund on MarketsMojo. We have Franklin Templeton Investments Value Fund. Okay, the 5-year CAGR is around very similar 11.5, which is quite good. And JM Financial also, which is the 12.8 5-year CAGR. Now these stocks, these mutual funds, their main purpose is to identify undervalued stocks in the market. So if you want to invest in this theme, you can also consider looking at mutual funds. Before I end the session and open to a Q&A for the QnA session, we do have an offer of 2699 for 33% discount. And it's for 2 years and you're getting a 3 months free since you attended this webinar. I'll ask Mehtab to flash the link on the website. And then let's open the flow for the Q&A session. Okay, so we've looked at the valuation. We've looked at different strategies. You can ask me any questions regarding these.
The first question for today is from Mr. Chaco. Price to earnings ratio. If earnings come down due to poor performance, the PE ratio goes up. Isn't it misleading? How do we do PEG ratio? It is ration of PE ratio, growth percentage.
Yeah, very good question. And this is one thing why in the recent past, people have now stopped looking at PE ratio, just solely at PE ratio. And people have started considering PEG ratio. Now, let me try to explain what Mr. Jaco has said. Okay, with this PE ratio you're looking at, as he said, if the earnings or like the denominator comes down, the ratio goes up. So we might think that the price is actually moving up, but it's not actually happening. When you discount it with the growth, which is PEG, you get a much better idea of a particular stock. Okay, and when we discount growth, when we use G, that growth ratio, we look at the annual EPS, the growth in the annual EPS, okay, trailing 12 months EPS. Okay, and that's how we enter the growth in the equation. Instead of looking at the PE ratio, that's why when I made the filter, so I don't look at PE, I looked at price to book and then I looked at other ratios, EV to EBITDA. Instead of going solely with PE, you all can start looking at PEG ratio. And the lower the better. You can also add these in your screeners to actually identify. So if you go to screener over here, I'll just clear all filters. Okay, and here if I go to valuation factors, so he's asked about PE ratio, okay, and he's explained one disadvantage, so you can add PEG instead, okay, and the lower the better. So if you find a particular company which is lower than 1, it's quite good. So here you can go into a particular industry, let's say, I'll select finance and NBFC. Okay, here is the PEG is calculated, the lower the better. Something which is a very high PEG is not something to be looked at. Yeah, we can go to the next question.
The next question is from Mr. Bala Sundaram. Hi Jason, thanks for the session. You gave an example of Star Cement which was bullish, but the quality dot was yellow. Do you still recommend it?
So it totally depends on your risk profile as well. If I share my screen and take you to Star Cement, we can get a better idea. When we recommend a particular Mojo stock, the one particular thing we focus on is the quality dot, which is our gatekeeper. So if you just share my screen, before we actually recommend a particular stock, we look at this quality dot over here. The reason we look at quality is because it looks at consistency. What can happen is that look at this growth over here is currently red. So when I say growth is red over here, if you see the sales growth has been 10%, the operating profit growth has been -8%. It's not extremely consistent. I normally look at, for me, these two ratios these two particular values have to be positive and higher the better. Okay, there's not seen much growth. So what might happen is you might enter this particular stock, but since it's not been very consistent in nature, look at this. The financial trend has been negative, 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 and suddenly it's been positive. Okay, if it was green all over a longer period, that's when I would say, you know what, the quality can be good and I'll be much more comfortable in entering. Now, what can happen later? Since you asked me this question, let's say if I extend this chart and the financial trend continuously improves, okay, it continuously improves. Instead of 8, we get 9, 10, 16, 20. The stock prices also move up, and that's when the quality will also turn green later. So if you enter the stock today and it does well and it continuously does well, your entry point will be earlier and you might get a higher capital appreciation. But in case the company doesn't do well, let's say it's been red, and it goes down back and starts being red, that's when you will lose out on some capital. That's why good quality companies is something which is very important because they've showed some consistency. This company's quality is average. Okay, so that gives some, it's for a person who's ready to take the risk. Okay, it's not for someone, and it's also a small cap over and above it. It's a smaller company. So that's, you will have to look at the amount of, you'll have to be ready to take that risk before investing in Star Cements.
The next question is from Mr. Bhargavi. Sir, if the price is above CFT score, does it mean it's overvalued or is it going to correct?
No. So if I just, let's look at the CFT score. Okay, I'll take you to one particular company. Let's look at Mastech, for example. Can you just share my screen? So I'm on the CFT score of Mastech. What Bhargavi asked is CFT is nothing but the current financial trend. Okay, that's why it's CFT. Okay, now this particular thing is an axis over here. So 0 points, 20 points, 40 points, and this is the price axis. It does not mean that if it's above and below, it will correct, so on and so forth. It doesn't work like that. Okay, this chart might be an example of it, but it's just the price movement and this is the CFT score. Okay, for example, here the CFT score has been good, but the price wasn't moving well. But if you see the series, so we recommend the stock somewhere here, but if you see the series of financial trend score was upwards, but then finally it moved down, currently it's negative and it's not doing well. Okay, so stock has seen some correction. But this price chart is just the axis which has been fitted. It doesn't mean if it's above, it's below, and so on and so forth.
The next question is from Ms. Anjali. X-Clerk has given -10% return in last month, and on website it shows mildly bullish. What does this mean?
So let's go to E-Clerks. There, if you just share my screen. So E-Clerks has given some -10% returns. On the website, it's showing mildly bullish. So let's look. So the technicals over here is not simply for 10 days or let's say 2 days. We look at weekly and monthly periods. Now what has happened is that the stock has turned mildly bullish from bullish. If it continues to go below, then it might turn flat and then sideways, and then it might turn mildly bullish. So some of the indicators have been started turning bearish over here if you see. Okay, but it's not completely gone below. So the stock is still a 71 buy. But if you look at the price trend along with Nifty being correcting, the price has also been correcting over here. Okay, so simply just because one thing has turned -10 doesn't mean the technicals will turn bearish. Okay, it takes some time because we're looking at weekly and monthly indicators for understanding the technicals.
The next question is from Mr. Karthikeyan. As per you, which valuation matrix should be given importance and in what descending order? after considering other aspects like Mojo score, performance analysis, technicals, etc.
After considering aspects like Mojo score, performance analysis, technical. So, giving a particular weightage, I don't have an answer for that. If you ask me anything to consider on a descending order, which is very important, the holy grail is the Mojo score. So Mojo score looks at many things, and if the valuation might be attractive for one stock, it might be expensive for the other one. The final call is actually the Mojo score. Now, the thing about the weightage of which valuation metric, when I don't have any great idea about that was used in MarketsMojo, it's completely confidential. Okay, but first thing I would say, if you want to look at, is Mojo score. Second thing which I personally look at is what the market has been doing with that stock. So I look at how the price movement has moved. I look at whether there is something in the market which is not being captured in the system but is actually happening. So I look at that as well. Okay, you can look at technicals as well. This is what I'm looking at. I look at financial trend. I wait for every if I'm following a company, I actually look at its fundamental performance. Because the fundamental performance is good, the company has potential to move forwards. So if you ask me, I look at the Mojo score first. After that, I look at the near-term drivers of the CFT and technical. And then I look at valuation and quality, which are long-term drivers.
The next question is from Mr. Neeraj. Please suggest courses, books on learning mutual funds. I have fair knowledge but lacking in the selection process.
There are no books as such. What you actually learn is when you read a lot of articles or you actually go and research on the website. Okay, there are no books. There is a particular exam which you can actually give. There is an NISM 5A mutual fund distributor exam, but that is mostly of theoretical knowledge and something of how you can identify different funds. Okay, books as such, I don't know of any, to be honest. And what I normally, the knowledge I try to learn and read is via different articles, reading, researching it by myself. So I'm not actually sure of any particular books. Courses, you can actually find a lot of them on YouTube. The best thing about finance today is if you want to learn something, no one can stop you, at least in the finance field. You simply go to YouTube and you search any particular term and you'll get a lot of content creators actually providing a lot of good information, okay, including MarketsMojo as well. So YouTube is another way you can learn about mutual funds.
The next question is from Mr. Satish. Can you review GE Shipping and confirm if it is undervalued and I can enter?
Yeah, we'll just search about GE Shipping. Okay, so the stock has, if you just share my screen, the stock has gone up by around 4%. Okay, if you look, it's 85 strong buy, so it looks very attractive. It's a mid-cap stock. Consistent financial trend, one of my favorites. Okay, so you can see the financial trend is consistent over here, 31, 34, 30. Since it's a strong buy and it's in a mid-cap segment, it's good to go. Okay, it's not a Mojo stock, so it's not been selected over here, but it's very high at 85 and strong buy. So your question is, can I enter this particular stock? If it fits your portfolio well, it's a good time to enter. Let's look at the valuation snapshot. So till 905 to 1079, it's fair, and 1100, it's an expensive stock. So currently, if you look, it's something which good you can enter. And also, if you look at the shipping industry over here, I think this is one of the stocks which is a strong buy. So within the entire industry, the close peers, GE Shipping is the only one which looks good. If you look at SCI, I think it's the second best stock to look at. But I think GE Shipping is the one which kind of looks good today. Okay, SCI is the next one, but it's 58 at hold. Yes, you can enter as long as it fits your mid-cap allocation, okay, and also if you don't have overexposure of shipping. What I mean is basically if you can see this particular card over here before buying any stock.
The next question is from Mr. Rajiv. Last week the stock price has come down from 820 to 745. As a result, the stock has come down from fair valuation to attractive valuation, and the score is still 71, which is a buy rating. This stock has all 4 green dots. What should be our approach in such situations? How should we take help from the technical analysis in such cases? Currently, the price is at 50 DMA. Should we take it as a support zone and buy the stock if it does not fall below 50 DMA?
Okay, so it's quite a long question, and what Rajiv has explained also is quite good. Now, if the stock has come down, let's say from 820 to 745, okay, I don't know the stock you're actually referring to, but if I just look at this as a case study, okay, and it's quite interesting if you listen to it. The stock has come down from 820 to 75 because of this. That fair valuation, that price has now become attractive. Okay, now it's become attractive, so the score will also improve, which is fine. Stock has all 4 green dots. Let me just take you to this particular ratio here. Just give me a second. This is the first particular formula I explained, and thanks Raji for asking this question. So you can keep the question on the slide, but also share my screen if you don't mind. Okay, so now this stock has actually taken some beating over here. Okay, let me just, yeah. So the stock price has come down from 820 to 745, and the stock's fair valuation has become attractive. It's 71 at a buy rating. Even though the stock has all 4 green dots, now we believe the intrinsic value of that stock is high. The stock can look upwards, but the market is, something is happening in the market due to which has taken a big fall. One, it could be the reason of Nifty. Nifty must have fallen down. I don't know the name of the stock, okay, but I'm just trying to guess the reasons. Nifty has fallen down, so the price has fallen. Let's say there's a corporate governance issue with this stock. Okay, or let's say, for example, there's a better competitor in the industry. There can be many reasons over here why the stock has come from 820 to 745, but still it's a 71 strong buy. It's a good intrinsic value, is good for the stock. Now, you should look at the actual 3 reasons what are happening in the market, which is why it is falling down. Is it a corporate governance issue? In that case, no, you can avoid the stock. Is it simply a price correction from 820 to 745? There's no much news in the market, okay? Or let's say, for example, there's a better competitor, someone else is moving your money to other stock. You have to look at many of the reasons why it's happening and then think of this particular stock. Now, what you suggested over here of technical analysis, this is one thing you can use, okay? This is one thing you can use as support. People use technical analysis as support. But what I try to look at, apart from technicals, if that fundamental, the reason you bought that stock, if it's still alive, okay, it's just that the market has reacted to it. But the reason you bought that stock, if that fundamental reason is still intact, the 4 dots are green, then there can be a time later when the stock is actually moving upwards. Okay, it might not happen in the recent, but let's say later the market realizes, okay, you know what, this is a good buy stock, it can move upwards. Okay, so you can use 50 DMA as a support zone, so it's quite a good strategy to use. You can try that out.
The next question is from Mr. Ajay. What is ultimate and final screener for undervalued stock search?
Ultimate and final screener, okay. So I have showed you all 4 different screeners. If I had showed you all one particular screen, it doesn't make actual sense. The reason for that is different screeners fit different investors' profile. Different screeners should be used at different markets. What I mean by that, now in the current market when Nifty has corrected by 9 or 10%, that's when you look at the returns year to date. Okay, let's say there was no correction, then I wouldn't look at the past returns. Okay, because the prices are moving upwards. There's no one and ultimate final screener. The 4 strategies I've showed have to be used. So the knowledge is not about using one screener. The knowledge is about using which screen at which point of time. Okay, what I mean by that is sometimes value stocks might work. Sometimes growth stocks might work. Sometimes momentum stocks might work. If you want to be a successful investor, you should not know these strategies, but know when to use which strategy at what period of time. Okay, so there's no ultimate screener for this one.
The next question is from Mr. Arun. Which time is good to invest in a stock?
Again, there is no particular good time to invest in a stock. There are good times to actually consider equity as an investment. What I mean by that is many people try to time the market over here. They say, you know, this is a good time, this is a bad time. In the equity market, you cannot find this good and bad time. You should always remain invested. Your question is slightly incomplete. Which time to invest in which stock? If you explain me the stock's name is when I'll be able to help you in this one.
The next question is from Mr. Tarun. Stock of which field are expected to go up in defense, railway, etc.?
Okay, so I'm not actually sure about which one particular sector will go up. But if you see in times when the market is really volatile, many people shift to defensive sectors. What I mean by that is currently I had given you an example of, let's say, Godfrey Phillips, which is a cigarette brand. In uncertain times, people don't quit smoking cigarettes. So during that time, people normally move to defensive sectors. If you ask me, currently I don't have a very strong idea of which sectors can actually move up. if I would be in your place, I would not actually look at one particular sector or theme. What I do is I start from bottom to up. So I don't have any particular strategy or idea apart from a sector right now.
The next question is from Mr. Shravan. Please review West Coast paper.
Sure, I'll just go to the website. Okay, so when I go to West Coast paper, the first thing which shows over here is 85 strong buy. Okay, the stock has gone down a bit. Okay. Now currently if it's a strong buy, it's a good to go thing. I normally look at the score. The best thing about this particular paper stock is it's currently very attractive range, much below the attractive range also. It's 516 today. The very attractive range is at 583. Okay, I had actually given Andhra paper for you all to review. You all actually looked at West Coast paper. Okay, so it's quite a good stock, so I don't see any particular reason for not. If you look at the returns though, okay, the recent return has gone up by 6% in 1 month. So the market has gone down by 3%. This has gone up by 1%. So it's outperformed the market in the near term range. Okay, so I think it's a good one.
The last question for today is from Mr. Webhub. Please explain more on Yes Bank's future trends as per valuation.
So when I checked the price of, so the valuation of Yes Bank, I saw it as expensive. If you ask me, the future trend is not, I'm not really an expert when it comes to Yes Bank and also the banking sector. But if you see currently the banking sector is facing some headwinds. Banking as a sector, many of the people are actually staying away from. You're talking about a company where people are actually staying away from banks itself. Okay, Yes Bank is something which investors are not kind of preferring right now. Okay, they are actually, if you talk about banks as well, they're talking about much stronger fundamental banks. Back then as well, when the stock was crashing, many people told me it's a very value pick. Okay, people saw that 10 rupees, 15 rupees and said, you know what, ये 10 रुपए में 15 रुपए में मिल रहा है, so it's very attractive. I still feel at 15 it's currently not a good stock to actually go into. Okay, I'm not, this is one particular statement, so just give me a second and that particular statement will give you your answer. Okay, so I'll just Google it. Okay, if you just share my screen for a second. So I kind of found it on Google. This statement by Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. When I talk about Yes Bank, okay, I can say it's like a fair company, ज़्यादा कुछ खास नहीं और price बहुत अच्छा है. But I'll not buy this. Instead, I'll buy a company which might be slightly expensive or might be at a fair price, but it's a wonderful company. When I say wonderful, its quality is good, strong. You can rely on the management. There's no particular corporate governance or smell in the company. Okay, and if it's at a fair price, I would be okay. But even though Yes Bank is at 15 and you know, currently it's not for that fundamentally strong, or let's say it had a corporate governance issue, I prefer to stay away from that particular stock. Okay, do we have any other questions?
That's it with the QnA session.
Yeah, thanks. I think it's 8 and we've actually reached towards the end of the session. I think there are some of the questions I've not been able to answer, but I hope I could actually make you understand what is this value we talk about, how is it different in textbooks and much different in the market world due to expectations and things. Use these 4 different strategies to get a better idea, and I also showed you all 3 different Mojo stocks and 3 different mutual funds where if you want to invest in this value-based theme. Thanks a lot everyone for joining today's event. We'll be shortly sending all the invites for the events next week. On Monday, we'll be having latest edition to Top Stocks. Goodbye and have a great weekend. Thank you so much.